Hi, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. Today, my guest is David S. McAlvany, CEO of McAlvany Wealth Management. David, thanks very much for coming back on the show.
Good to be with you.
So it's been a while. I'd like to get your thoughts and impressions heading into the elections and, of course, the looming fiscal cliff. What do you see for the economy and financial markets in the coming year?
Constrained growth in the U.S. Of course, we still have problems in Europe, and China continues to slow. I think those are issues that are very macro and offer some drag. But what we do see is central banks all acting in unison to do something. Now, whether it's effective or not is a secondary question, but the markets have become unhealthy in the sense that they're reliant on central banks to say something.
That's the sugar high they all talk about.
And so that's the real question is, will they translate from just talking to more doing? At least in the United States, that's the case in point presently. The Fed has said they're going to do something. They haven't done anything. Even since the announcement of QE3, they have not expanded the balance sheet, I think in part because they know it's not effective. So now they're caught on the horns of a dilemma. They've promised to do something. If they don't do something, are they punished for it? Does the market revolt, so to say? So they're in a real bind, I think.
Now, even if they did something, though, would that really make a difference? Because, and we discussed this the last time, and the QE, forget about Operation Twist or doing it in a sterilized fashion. Let's just say an outright expansion of the balance sheet. It's just an asset swap, right? I mean, the Fed is removing some asset from the economy, a treasury or a mortgage-backed security, replacing it with reserve balances in the banking system that basically just sit there. We know the Fed pays interest on reserves. But what we also know is that you're stripping out, you're removing a lot of interest income from the economy. And you could actually go and look at the data since 2008 or 2009 when they started all these extraordinary measures. Something in the order of $400 billion out of personal income through that interest channel. So, I mean, the talk of stimulus, is it really? Because they're taking a lot of income out.
I think to some degree it's stimulative, but what you really have to connect is it actually creating jobs? I mean, is there a connection between what they're doing and the larger economy, the real economy? And that's where I think there is a disconnect, where on the one hand, academics are approaching it from the standpoint, they know what they know. Unfortunately, they don't know some things that they need to know, which is sort of how things work in the real world. And I'm not saying that there's not a bunch of very bright people at the Fed, but I think market practitioners would say, listen, this isn't going to get you where you think it's going to.
I saw a statistic, it was a mind-boggling statistic, that the Fed was kind of, bragging that, hey, with our $2 trillion expansion in the balance sheet, we helped to create 1 million jobs. Well, that came out to something like, $1 million or $2 million per job. It would seem like at that cost, you should be able to create an awful lot more jobs at that cost, right?
Sure. Well, it's the same thing we have with farm subsidies. We should buy $1 million mansions and a couple of Porsches for every farmer in the Midwest because, after all, they're not exactly producing at what is a market rate. So we've done that before. Pat ourselves on the back for things that are actually a little silly. You're right in pointing that out. For us, I think where we do see a void is in monetary alternatives. The Fed is mismanaging our currency, and the ECB is not exactly a stable alternative in terms of the euro. So for individuals, and we're seeing a growing trend with central banks, it is to find a monetary alternative to the dollar. And to some degree, we're seeing that move in the direction of gold. We continue to see central bank purchases on the rise, and the non-official purchases from the Chinese, our contacts in Hong Kong, expect each month between 30 and 40 tons per month coming through Hong Kong for central bank purchases. So that to us is a compelling case for a move higher in gold over the intermediate and long term. And for the average investor, that does mean that silver is going to come along for the ride. It tends to follow along in fits and starts, much more speculative in that regard, but probably the better value between the two for the individual investor.
So as a wealth manager, which is your business, gold is your number one area right now that you would be putting client assets into?
I think we're still in that strange place of sitting the fence between a healthy cash position, a very neglected asset class, in my opinion, and a healthy metals position, which would be allocated partially to gold and partially to silver, with the expectation that silver is probably the outperformer over, say, an 18 to 24-month period. So not a short-term a trade, so to say. But that ratio of gold to silver, 53 to 1, it's come down off of close to 60 earlier in the year. And for it to settle into the 40s would be normal, outperforming gold on the way.
If your view is that, people are going to continue to move into gold for safety, for protection, or on the belief that central banks are going to have to continue what they're doing and somehow that's going to debase or devalue the currencies, why not just go all into gold then?
Well, I think there is still the issue of deflationary snaps affecting individual asset classes. That could be asset-backed, mortgage-backed, commercial mortgage-backed securities, pockets of vulnerability still there. Keep in mind, we went over the last 30 years from $5 trillion in liabilities to a system that has $54 trillion in credit growth or liabilities. So this is where we do see at some point there will be a step back. We don't know when or to what degree or even what asset classes are involved. And maintaining a cash balance we think is prudent. But certainly a heavy emphasis in the metals to us is essential. And you hit the nail on the head. It's not necessarily the growth prospects, but it is as an inflation or deflation hedge. It always has been an insurance component, and that's where it should be identified as an insurance component. Monetary alternative would be the other way of looking at it.
Now, what about the fiscal cliff? That's fast approaching, the amount of cuts and tax increases that would bring about, some economists have estimated as much as a 5% negative GDP. That's a very bad recession. I mean, we saw a 5 or 6% negative handle maybe, in 2000, late 2008 or beginning of 2009. We were losing 800,000 jobs a month. How would that affect? I mean, you would have to assume that would pretty much roil the markets.
It would roil the markets. I think our legislators are assuming that the Fed is going to step in and do more. Again, what would that be?
Yeah.
And there has been more talking than doing, as we've said, with QE3 or QE Infinity. It has yet to sort of get geared up. The Fed balance sheet since the announcement has actually contracted, not expanded. So no real activity there. What would they do for an encore? I don't really know. I don't know what they would do for an encore, but they better get that message to our legislators, because our legislators are holding on to the hope that the Fed is going to somehow pull a very large rabbit out of the hat just in the nick of time.
Now, let's talk a little bit about the election and the prospects, given the two candidates. Do you see any big differences there? I mean, if you look at Obama the last 4 years and, the job situation is still pretty poor, but we have in the last 2 years created about 4 million private sector jobs. We've seen the stock market double from its lows in early 2009. We've seen a turnaround. Even real estate is starting to come back now. So there has been some improvement, although granted the economy is still operating at a very low level. What about Romney? Do you think his economic policies, from what you've heard so far, present a more bullish picture?
Well, I think clearly the difference is socio and political in nature, and the economic and financial. I think you really are looking at the same team, just different colored jerseys. I mean, so that really, there's a few differences. But I don't think there's going to be a different outcome in terms of the next several years. You need to see cooperation in the legislature. That's actually where the real reform and change needs to be taking place. The only thing that could be said about an Obama victory is that he could attempt to get a lot done. He had 932 executive orders, more executive orders under one administration than all presidential administrations since the beginning of our country. So if he doesn't get his way, he apparently is going to do something anyways. But again, the dividing line is socio-political. Economic policies and the results financially, I think you're looking at virtually the same. Not a lot of difference between the two. More figureheads for the party, and that's where both parties are. What is the difference? You tell me.
Does it bother you at all that the mainstream economic and policy view is that we need to impose austerity? We're seeing it in Europe. We're maybe going to have our own austerity, yet the results that we see from that austerity is contrary to what they're trying to achieve. We still see the deficits. We see unemployment skyrocketing. We see growth stagnant or negative, and we see all kinds of riots in the streets. Does that bother you at all, that we keep pursuing the same thing and coming up with the results that we're trying to run away from?
Well, I think it's a question of timing. When do you implement something like that? And this is a pretty tough time to get that done. I don't think anyone would disagree. We need to live within our means. If your tax take is $2.5 trillion, the budget should be $2.5 trillion, or maybe even less. Run a surplus. That would be okay. But to be running $500 billion to $1 trillion deficits and try to find faith in fiscal conservatism now is actually a little bit awkward. I agree with you. To implement it now, you're probably going to make it a lot worse. But the reality is we should be living within our means to begin with. Can you do that in the context of a democracy? If you go back to World War II and the expansion of suffrage, universal suffrage after World War II, the budget's politicized. The budget's politicized. Politicians are promising too much. I mean, it essentially is official corruption, an official form of corruption, and how do you back away from it? So they can talk tough. The reality is they're not going to get tough, because when they start cutting spending, you know what's going to happen. You're going to have people voted out of office, and nobody wants to lose political legacy. So that's the problem with democracy and sort of budgetary constraints, living within your means. I think we moved past that a good 20, 30 years ago.
Democracy facing problems. David McAlvany, thank you very much.
Good to be with you.
That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.